Welcome back, future CMAs. As an experienced lecturer for this exam, I am absolutely thrilled to have you here today. We are tackling a topic that is, honestly, the heavyweight champion of the Part 1 exam, absorption costing. Sometimes you'll hear it called full costing. Look, if you're preparing to conquer this exam, mastering this concept is completely non-negotiable. It's the absolute cornerstone of external financial reporting, and by the end of this explainer, you're going to know it inside and out. Okay, let's dive into this. Have you ever wondered why your company's internal management profit numbers almost never match the official reports that get sent off to the bank or the tax authorities? I mean, it can feel like a total magic trick, but it's really just accounting rules at play. Understanding the difference between how we absorb costs into a product versus how we treat them as immediate expenses is the key to unlocking the whole mystery. And trust me, getting this dynamic down cold is a guaranteed exam winner. So here is our roadmap for today. We'll start with the GAAP reporting mandate, then packing the product suitcase. Third, we'll look at the fixed overhead trap. Fourth is the traditional income statement format. And finally, we'll wrap up with some essential CMA exam pro tips. Let's kick things off with Section 1, the GAAP reporting mandate. Up until now in your studies, you've probably focused heavily on how to simply measure costs to understand your own internal operations. But now we're shifting gears. We're looking at how we are legally required to report those costs to the outside world. So what is absorption costing? Well, it's the mandatory method required by GAAP, generally accepted accounting principles, for external financial reporting. The name itself is actually your biggest clue here. It ensures that a product absorbs all manufacturing costs. It literally does not matter if a cost is variable, meaning it bounces around with production volume, or if it's fixed, meaning it stays flat no matter what. Basically, if a cost happened inside the four walls of the factory, it is going into the product. No exceptions. Moving on to Section 2, packing the product's suitcase. And this brilliantly illustrates the entire concept we're dealing with today. I want you to think of every single product your company makes as a traveler, and every traveler is carrying a suitcase. When we use absorption costing, we have to decide very, very carefully what gets packed into that suitcase to travel with the product and what gets left behind at the terminal. To do this right, we draw a hard line between two specific categories, product costs and period costs. Product costs are inventoriable. They stick to the product like glue. They get packed right into that suitcase and they live on your balance sheet as an inventory asset until that specific item is finally sold. Period costs, on the other hand, they never touch the product. They completely miss the flight. They're expensed immediately on the income statement for the period they're incurred. This includes all your SG&A, your selling, general, and administrative expenses. Right, so what exactly goes inside the product suitcase? Well, you pack your direct materials, your direct labor, and your variable manufacturing overhead. But here is the absolutely crucial one. You also pack fixed manufacturing overhead. Please star, highlight, and circle this in your notes. Fixed manufacturing overhead is the big one. It's the defining characteristic of absorption costing, and I promise you it is exactly what the examiners are going to aggressively test you on. Which brings us to Section 3, the fixed overhead trap. Because we literally force fixed manufacturing overhead into the product's suitcase, it sets up a really dangerous dynamic. And examiners absolutely love to use this to try and trip up candidates. Let's put some numbers to this to make it concrete. Imagine your factory produces 1,000 units this month. But market demand is a bit sluggish, and you only actually sell 800 units. That means you've got 200 units left over just sitting on the shelves in your warehouse. So the million-dollar question is, what happens to the fixed manufacturing costs associated with those remaining 200 units? Well, they don't hit your income statement. Because those units haven't been sold yet, their specific portion of the fixed costs stays trapped inside their suitcases, parked on your balance sheet as an inventory asset. In the eyes of GAAP, you haven't technically expensed that money yet. Let's map out exactly how this trap springs, because the business implications here are massive. Step 1. A manager deliberately decides to produce more units than they actually know they can sell. Step 2. By doing this, they effectively hide a large chunk of their fixed manufacturing costs in ending inventory over on the balance sheet. Step 3. Because less fixed cost is being recognized immediately as an expense, cost of goods sold artificially drops, and net income automatically rises. This is a huge point of discussion when evaluating manager performance. Why? Because a manager could theoretically manipulate production lines just to boost their short-term profit and hit their bonus targets, even if sales haven't improved one bit. Let's move to Section 4, traditional income statement format. Let's move to and see how this builds into the reporting structure you actually have to use on the exam. Here's the specific calculation structure you need to have memorized. You always start at the top with your sales revenue. Then you subtract cost of goods sold. And remember, under absorption costing, COGS includes all variable and fixed manufacturing costs. Doing that gives you your first major subtotal, gross profit or gross margin. From that gross profit, you then subtract your operating expenses, which is all your non-manufacturing stuff, your SG&A. And finally, that leaves you with your operating income. It is absolutely vital you know exactly what is deducted to reach that gross profit line. Now, what's really interesting about this slide is how we are categorizing our costs. Notice that in the traditional format, costs are grouped entirely by their function. We separate manufacturing costs, which go up into COGS, from non-manufacturing costs, which go down into operating expenses. We do not group them by their behavior, meaning we don't separate variable costs from fixed costs on the statement. They're just mixed together based entirely on where they physically happened in the business. All right, Section 5, CMA Exam Pro Tips. You've got the concepts down, you understand the mechanics, so now let's make sure you have the exact weapons you need to secure those points on test day. Here is your punchy checklist. First, absorption costing is mandatory for GAAP and IFRS external reporting. It's not some optional management tool. Second, it is a full cost method, meaning it strictly includes fixed manufacturing overhead in the unit cost. And third, because of how it handles that fixed overhead, your reported profit is directly affected by changes in inventory levels, not just changes in your actual sales volume. And here is the ultimate pro tip, the classic comparison scenario examiners will inevitably throw at you. When comparing absorption costing to variable costing, remember this golden rule. If production is greater than sales, absorption costing will always show a higher profit. Why? Say it with me, because of those trapped fixed costs hiding out in the product suitcases over on the balance sheet. I want to leave you with a somewhat provocative thought to chew on before our next session. We just saw exactly how overproducing inventory can artificially inflate net income by trapping fixed costs. So, does this idea of hiding costs in inventory make ethical sense when you're trying to evaluate a manager's true performance? Or does this accounting rule actually just incentivize really wasteful production? Think deeply about those incentives, keep that suitcase analogy fresh in your mind, and I'll see you in our next explainer where we tackle the fascinating alternative, variable costing. Keep studying hard.